everyone. Thanks for subscribing to my channel. One of the most common questions my students ask me is, how can a company that is making profit go bust? In my book, Managing Your Leisure Services Budgets, I detail the different accounting methods in use. With a very few exceptions, accounting methods seek to match money with time. And the time here means the time the transaction has legal effect, not the time that the cash is paid or received. So when a transaction takes place on credit terms, the effect must be recorded in the accounts on the date of the transactions, even if the cash is paid or received days, weeks, or even months later. And we call this the accruals or matching concept in financial accounting. Let's look at an example to illustrate this conundrum. Michelangelo has been awarded the contract to paint the ceilings in the Museum of Art Angels. The total value of the contract is £300,000. Now, because the museum trustees require that the museum remains open so that the public can enjoy the benefit of the art exhibits, the contract will take place in stages over a period of 3 years. Here is a money picture of the contract. The total revenue from the contract is £300,000. Michelangelo has budgeted for £25,000 a year in materials for each of the 3 years, a total of £75,000 of material costs. This will leave him with a total profit of £225,000 on the contract. Now, as important as the contract terms are the payment terms. If you've been involved in any building project yourself, you won't be surprised to see that Michelangelo will receive an advance of £25,000 towards his material costs. The second payment is due to be made at the end of the year. £25,000 will be paid, and that's subject to certification of 1/3 completion of the contract. £50,000 is due to be paid on December 31st, 2016, subject to completion of 2/3 of the contract. And the balance will be paid on December 31st, 2017, subject to full completion of the contract. Here is the profit flow from the contract, showing each year's expected profit. Now, you'll recall that the total revenue from the contract was £300,000. Under the accruals concept, we split that evenly across the 3 years. So here we're showing £100,000 revenue for each of the 3 years of the contract. Michelangelo budgets to spend £25,000 each year on his material costs, giving a total budget for costs across the 3 years of the £75,000. This will leave him with a profit each year of £75,000. For 3 years, here's the total of £225,000 in profit. Michelangelo can't wait to get home that evening to his young, slim, blonde wife. "My lovely Mrs. M, I've got the contract at the museum. £225,000 profit." "Ooh, Mikey, I knew you had it in you." A night of passion follows, and in the morning, Mrs. M orders a new kitchen. 2 weeks later, Michelangelo is woken early in the morning to the sound of lorries driving into the front of his house and knocking on the door. "My lovely Mrs. M, do you know what this is about?" "I'm having a new kitchen." £225,000 profit, you said, Mikey." "But my dear, the cash won't arrive for 3 years. We can't afford a new kitchen now. Look at the cash flow figures. In the first year, the museum pays me a total of £50,000. But I only get £25,000 this month. I have to wait 12 months for the second payment. And I have my expenses of £25,000 on materials to pay out before I can even start the job. So this year my net cash flow is only £25,000. And next year it's the same picture. It's only at the end of 2017 that the money rolls in. Well, if that's your attitude, Mikey, I'm going off with a builder. A beautiful relationship damaged, all because someone did not understand the difference between profit and cash. Would you agree with me that many people would take the same attitude as Mrs. M? They would see reported profit and think, I can spend that. But not you, of course. So maybe you're thinking, well, what would I do differently? Well, perhaps you could expand your business and take on contracts that will pay cash in 2015 and 2016. Perhaps you could renegotiate the contract with the museum. Or possibly you could see your bank manager and arrange a loan to cover the period before the cash rolls in. And you could use the security of the museum contract for this loan. Can you begin to grasp what I mean? But what you must always do is prepare a cash flow forecast. Don't let your cash flow be all flow and no cash. Thanks for being on this call. Keep learning how you can manage cash and join me next week.